Welcome to this next episode of Governance Dialogues. My name is Elisa Cole, and I'm the Managing Director of Governance Center, and I'll be your host today. And for those of you who are joining the program again, welcome back. For those of you who are new to the program, please feel free to subscribe to our channel, which is treating corporate governance and governance challenges more broadly in conversations with world's thought leaders on the subject. And in today's episode, I've actually decided to delve into a topic that we haven't yet had a chance to treat at any length, and that is the intersection between corporate governance and private equity industry. And I've invited Mark Maybank to join us today. He's a veteran in the industry, if I may say so, and he'll be joining us today from Canada to talk about some of the challenges that we're seeing in terms of governance of the industry itself, but also, and more specifically, in terms of the governance of investee companies, and so companies that private equity funds invest in. Mark, it's such a pleasure to have you on the program today.
It's a pleasure to be here, Alyssa. Thank you for the invitation.
Thank you. And I think the timing of this conversation couldn't be more timely, or couldn't be sort of more on the dot. The industry, as we all know, has grown tremendously in the last year or so. According to recent estimates, we're talking about 6 trillion of assets under management last year, with about another 2 trillion in dry powder. And I think that latest estimates suggest that will double in the next 4 to 5 years. I'm not sure if you agree with those numbers, but we'll talk about that in a minute. And so clearly there is a shift in mindsets, also given what is going on in the public equity markets. I think in the turmoil that we're seeing in that space, a shift in investing that favors the industry that you're in. And with that, of course, come responsibilities and questions that we can be asking ourselves as to how well are the companies that private equity funds invest in are run. So I'd like to talk to you, if you don't mind, today about some of these kind of thorny questions, and leveraging your experience investing in companies in Canada, the US, but also kind of in other markets in across the sectors that you've worked in. So from healthcare to oil and gas and other industries, which we'll get to in a minute. First opening question that I wanted to ask you it relates to what are the kind of provisions or mechanisms that you as an investor actually put in place to address some of the perhaps deficiencies that you see investing in companies in your portfolio and previously?
I think we're coming into a really exciting time in governance. A lot of people overlook governance when money's being made, and we're coming out of a tremendous multi-decade rate cycle where a lot of money's been made. A lot of governance issues have been overlooked. We're coming off of a period 2020 and 2021 when a lot of term sheets and deals were done governance light and covenant light, diligence light. And now the tide is going out. We're seeing, inflation rise. We're seeing risk re-rated, cost of capital, increasing 2 to 5x, depending on how you want to measure it. And it's going to bring to light a lot of governance issues, right? Governance gets easily overlooked when a company is making money. There's not necessarily, in my experience, a causal relationship between governance and a money-making organization. And so, we're about to go into tougher times, and a lot of those bare spots, covenant-like, governance-like structures are going to, be surfaced. So I think it's an exciting time to focus in on governance, and I look forward to seeing a bunch of your upcoming episodes and on some of those topics. But as it relates to specific governance provisions, those are a distinct function of, the nature of the business, the industry of the business, the structure of the underlying cap table or the shareholdings. So it's a little bit horses for courses. They're all very unique. Maverix, we're investing out of a growth equity fund. And so we take minority positions typically alongside, proven entrepreneurs. So by definition, we don't have control rights. We have kind of negative control and, approval over, normal operating plans, CapEx, obviously all kinds of protections around changes to business structure and, shareholder agreements and things like that. But we very much have a contractual relationship through the shareholders agreement with what is typically one lead entrepreneur. That differs very differently from an early stage venture where there's 3 or 4 or 5 different venture firms around the table, or a public company that's a little bit more blue chip in terms of operating. So, to drill down into specific provisions, we look for defensive positions to protect ourselves from a formal governance standpoint, but we add value through informal governance. And that is direct day-to-day engagement at the operating and executive level with the underlying portfolio companies. So I want to say provisions are important for defense. That's not where the value is created. That's done through informal governance, and that's based on individual relationships and engagement.
And that's interesting, the distinction that you draw between sort of what I understand are rather light provisions in terms of shareholder protections and kind of more value adding type of measures from a governance perspective that you mentioned. And I wonder to what extent they differ based on the company size, sector, or other parameters that you might that might come to mind in terms of the portfolio that you've invested in over the years.
Yeah, so the earlier stage, the easier the governance, because it's a much simpler business. Boards of 3 or 5 versus more established public company, mature, obviously more complex. And with that, you tend to get more protections at the earlier stage, and at the public stage, things kind of more blue chip, natural, in terms of checks and balances between the board and the executive team and the CEO. So in terms of our space, in terms of growth, we typically go in somewhere between 20 and 35% ownership. There's typically a control party that already has control. So so again, very different. The larger the size, we've got one that's, basically near unicorn status. And one of the issues we're still trying to take is, the entrepreneur's mom off the board because they're super defensive. So if you picture, an iceberg, the top you see above the water line is formal governance. Those are those defensive protective provisions that we talked about. All the values in the 90% of the iceberg below the surface. It's okay that the mom's on the board, because the board in itself, from a governance functioning standpoint, is only 5 people, and the CEO feels a little, defensive, so they're protecting themselves with, family members. So that board doesn't function like a super smooth, public company board, but we've got a great relationship with them, and the 90% of the governance below the water, the informal governance, is very active and very positive. So I think it's important to keep formal and informal governance in mind in terms of how value gets added and how the relationship gets steered.
Yes, and I can see some of the challenges that you were referring to in terms of the as you refer to as the entrepreneur's mom and running those boards, because in fact most company boards are composed of family members, and in some cases it's been the breaking point of many of the companies through the generations, but in some cases it's also been something that sort of carried forward large companies in different sectors. The Rockefellers being one example, but there are also many others that we can think of. And if I can ask you, so when you invest, you mentioned there are some sort of certain provisions that you ask that are more, from what I understand, kind of buckle down provisions that protect your shareholder rights. Are there any other elements or that have evolved in your investing style that over the years that look at more broader ESG parameters? I mean, as you know, there's been a lot of talk about also some of the work in ESG being pertinent to the private equity sector. And indeed, I think there was an INSEAD survey that was put out a couple of months ago that talked about, I think, about 77% of private equity firms they surveyed using some type of ESG criteria in their investments. What are your thoughts on this? And there's lots of polemic around whether it's whitewash or to what extent we're really talking about real mechanisms.
So I think whitewashing or greenwashing is prevalent. We do have an ESG policy. We take ESG into consideration, but not at the expense of investment returns. I think that the E side is getting a little bit more overlooked in the context of today's recession and a little bit our pending recession and tougher economic times. the social and the governance, I think, remain very active. And as I talked earlier, governance is going to become a super hot topic as the tide goes out and all those governance light agreements and kind of potentially bad behavior start to surface as companies go down and finger pointing starts. We looked at a deal today, and then there's another one kind of pending where they've got very complex governance structures, layer on layer of investor, multiple veto rights around the boards, various stalemates as they're trying to raise funds and who's going to do what. In the meantime, they're under down to 6 months of cash and counting. So shaping up for super messy situation. In that instance, governance is going to shy away. So I think the S and the G are going to get the attention. For us, we certainly take those into account. We believe in the diversity of thought and diversity of contribution at all levels of the organization, at the executive and at the board. So we take active steps to influence and persuade, to optimize diversity of thought, diversity of problem solving. The governance structures that we like to see start with the alignment of interests and not misalign interests at the governance level. So we want to be aligned with the entrepreneurs as economically as possible, with the same investment horizons, the same, vision, the same kind of direction and competitive positioning. So if you've got a bunch of those major factors in line, everything else tends to become much easier in terms of, voting rights and who's got what. So coming back to ESG, we do screen, but it's not the determining factor in our decisions.
Mm. And you spoke just a minute ago about complex governance structures, and I think a key word there is alignment of interest, and that's sort of what every governance model tries to do. That is the whole objective of the exercise, if we can say so. And of course, in your investments, I'm sure you faced scenarios where you have multiple voting class structures, especially when you look at tech companies. Some of them have extremely complicated multiple voting class situations. In some countries, they're regulated in terms of how much of the voting plus you can give. In others, in the US, you can really, like in Delaware laws, you can really go quite differentiated in that regard, and you can even potentially give or hand out these multiple voting rights to family members, not have them be limited by sunset clauses. And what I would like to ask is as an investor, what are your views on this on this kind of thorny issue of multiple voting rights? Has that served this alignment of interest that you spoke about, or is that can it be to some extent detrimental? And what do you think shall be done with it from an investor point of view?
So let me give you two parts of that. One is the Maverix Growth Equity Fund, where we take minority positions. We've got one at 20%, the entrepreneurs own the other 80. We're de facto in a minority position, whether they have multiple voting shares or not. It doesn't change the control dynamic. So for most of our investments from a Maverick specific perspective today, multiple voting shares are irrelevant. There aren't any in our portfolio, but we also don't have control of any of the investments. So it's kind of the same effect. Now, the question is, multiple voting shares is a tool. I am net in Maverix is net pro multiple voting shares to be used in specific circumstances. And I can speak specifically from a Canadian perspective. One reason I'm pro is because Canada is, to use the euphemistic term, it's a Christmas tree farm. We like to get our trees or our companies from a small stage to an intermediate stage, where they get chopped off and sold into foreign markets. What we do with our Christmas trees, we do with our companies. Why is that? Because we're right next to the US. We don't have a deep market for a lot of development. And so how does Canada convert a series of Christmas trees into a forest? And the answer is we do need our entrepreneurs to be armed with multiple voting shares to block outright sales of companies in the foreign markets. And having most of the entrepreneurs that we deal with are all kind of pro-Canadian development. And so giving them a targeted tool, and I'll show you we'll talk about the inverse in a minute, giving the entrepreneurs a targeted tool that can be applied with limitations, sunset, can't pass it down to the next generation, specific use cases, broader kind of governance controls. is a way to allow Canada specifically to convert intermediate stage companies into larger companies by allowing them to remain in Canada for longer. And now the flip side is, if it's not multiple voting shares at the public company level, what do you have? You've got one vote, one share, which, what does that really mean? So you've typically got 3 to 5 institutional investors that own between 30 and 45% of any given public company. You've got concentrated institutional ownership. 97% is the market share of the top 2 shareholder advisory firms, ISS and Glass Lewis, 97%. So the chances that those 3 to 5 institutions follow one of those 2, super high. So you've got them voting effectively as a block. Now you've got institutional decisions being dictated by shareholder advisory decisions geared on short-term quarterly performance, and they will sell off these Christmas trees earlier in order to hit quarterly performance, or because they think that the 30% valuation premium is reasonable. So one vote, one share doesn't really exist. It's really a de facto voting block driven by shareholder advisory services, is the alternative to multiple voting shares. So I think the average investor or the individual investor is ceding control to either the entrepreneur or to a group of institutions. That's the decision. And to which do you want your economic resources of your society determined? Do you want them determined institutionally, or do you want the entrepreneur who understands their competitive dynamic and competitive framework better? Do you want them to being the arbiter of resource allocation? Because at the end of the day, that's all governance is. It's how to allocate scarce resources in an economic setting.
Interesting. And we actually did, I had posted an episode in conversation a few months ago where we looked at specifically about the conflicts of interest posed by the concentration of the Glass Lewis, ISS, and the others. But that's a separate topic that our viewers can look at on the program. But to come back to multiple voting shares, I mean, and the issue that you referred to of protection of entrepreneurial rights, if I may then just be a devil's advocate for a second, then would other mechanisms be useful in that regard? And you know, during COVID, lots of companies, especially in the US, adopted poison pills and other governance mechanisms to protect themselves, let's say, from this Christmas tree situation. Is that something that you think would be equally acceptable in your view?
I think that it depends on, the short answer is it depends on the problem set and what problem is trying to be solved. Do I believe in massive governance asymmetries and overriding of control systems? The answer is no. Do I believe that there are specific governance sets or problem sets that may need certain tools? The answer is yes. And so if I take a look at the future of Canadian prosperity, Canada's standard of living, in that through that problem lens, the lens of that problem set, you can make arguments that different governance tools are needed to solve parts of that problem set than the traditional, one share, one vote model. So I approach all of those situations with neutrality and based on what the ultimate problem set we're trying to solve. Interesting.
And you referred in your answers a number of times to, this Canadian predicament, but obviously you invest in other markets, notably the US. Two markets are very different. One is, quite much significantly more concentrated in Canada in terms of the ownership model, at least in the public equity market, and the US, which was one of the more or most dispersed ownership models that there are in the world. And I wonder what your thoughts are about, the divide between, let's say, the Delaware and the Canadian legal model, and what are the tools or the differences in the approach when you look at a Canadian investment or an American investment? Would there be a different sort of sunglasses that you would wear?
Yeah, I think the answer to that is yes. In both situations, they're all over the map. You can have, really wide range. So I'm not sure that there's the range is any different one to another. I do think, in my experience anyway, the US tends to be a little bit more prescriptive and less principles based. So governance tends to be more detailed. Some of the governance must-haves are built around a litigation environment with, greater direct or personal liability. And so as such, I think you get a little more prescriptive, more detailed. Canada's a little bit more trust, a little more informal governance, and a little bit more principles based. And I'm super generalizing. The range of outcomes is probably the same. You can be super prescriptive in Canada, just the midpoint on either would be a little different.
If I may ask, so we canvass different geographies and different situations. You've obviously faced in your investing experience and history situations where some investments have proven problematic from a governance perspective, or you're aware of other situations that in other funds where there are issues related to, for example, related party transactions or other governance, let's call them gray zones. And I wonder if you could give your thoughts as an investor, from a private equity angle. How do you or other investment funds, let's say colleagues, peers in the industry, tend to deal with these situations? Because obviously in the private equity space, there are specific regulations as to how these transactions are approved, whether it's exposed, ex ante, board, shareholders, and every country has its own, let's say, soup of different regulations on that front. And in the private space, obviously that's up to you or the likes of your peers.
So what's amazing about that question is we're coming into, as I touched on, a period the next, say, 24 months. We've got probably another leg where the recession hits, earnings contract, and valuations take a bit of another hit as liquidity comes out of the system. That creates this lowering tide, which is going to expose a lot of problems. And 2020 and 2021 vintage deals are light on a lot of conditions, whether that be debt related or equity. So here's where I think the problems that are going to surface. You touched on related party transactions. When everybody's making money, boards tend to, defer to the dominant CEO. They tend to let things happen because everybody's making money. The valuations just doubled. Whatever's happened, everybody lets things go. So related party transactions, we've seen a number of structures where people like to put related party transactions in at a JV or at a subsidiary level that will require buyout or creates asymmetry in shareholder alignment, typically with a promoter or entrepreneur. I think we're going to see problems like that. Unwinding those are messy. The shareholders and the board, there's no easy unwind. I think we're going to see lots of stuff around the celebrity CEO, the dominant CEO who was given too much rope. Controls were were released. The CEO was making money. They'd taken the valuation from small to big, tremendous amount of leeway. They went through personal issues, made a bunch of money, got distracted, and all these get exposed when the valuation goes down 50, 75, 90, 100%, all the finger pointing starts. And we're going to see boards not taking an active role or fulfilling their obligations against that celebrity CEO. I think we're going to see gaps in the governance can't solve all problems. Even if you had good governance, there's still going to be write-downs, there's still going to be problems. A business model didn't work out. Those to me are natural failures. Everyone aligned on the vision and the strategy for the business. The agreements were underwritten, money was flowed, business didn't turn out, valuation was wrong. Governance, there's no way to solve that from being a money loser. The other thing I think we're going to see is active directors, and you see this with celebrity directors. I saw this just this morning, a list of candidate directors for this company, and they were all like celebrity, high profile, right? And they're on, I saw one, I think I mentioned to you before, he was on 26 boards, right? Not capable of being an active contributing director when you're on 26 boards. I don't know how you deal with the scheduling around trying to match boards, but assuming you get around that, how do you add value? You don't. So I think we're going to see pushback against the celebrity, the high profile directors who are on so many boards. And while that's been identified as an issue at the public level, it's less of an issue at the private. And people still put those forward because they think that it adds cachet, doesn't necessarily add value. I think there'll be more of that. I think CEO extractions are going to be a hot topic. As the business gets marked down 70% and the workforce gets wiped out by 2/3, and we've got to extract the CEO. What are the severance agreements? What are the powers and duties of the board? Can they actually fire the CEO? If they've got control, how do you transition them out gracefully? How is that done with finesse and nuance versus hard, legal-driven, high-profile CEO extractions? I mean, that's, key function of the board, and we're going to see a lot more of that over the next 12 to 24 months as economic conditions return. So, those are a few of the classic textbook problems. The solutions to those are not, none of those are straightforward.
Yeah, it's great because actually you use some terms. I mean, I obviously celebrity CEOs, it's something that we all know, and I've written quite a bit about celebrity directors and CEO extraction is something that frankly I haven't yet come across, but it's true. If we speak about the turn of the economic tide, and actually it's funny because we discussed this also with Anthony Shilipoti, who recommended you indeed for this conversation. And in the previous episode, I think it was called "When the Tide Goes Down, Who Will Be Sort of Left Standing Naked," and that was referring to the crisis. So we're kind of in a different logic. Only I think about a year from that conversation, and some of the governance fallouts that you were describing are also very interesting from the point of view of replacing of some of these board members. And these are all kind of all topics that we work on. For example, in many countries, when I write regulations on governance and I write many codes, a number of countries, even I can think of off the top of my head, even Saudi Arabia, for example, has limitations as to how many private company boards a director can sit on, as well as public. So I think maybe some of that, if I may just comes to mind as some of the things that might be coming also in the future of the regulatory landscape. But that aside, I think I'd like to ask you one last question before we run out of time. Obviously, in this context of this tide going down, if there are these situations where CEOs need to be replaced, there's issues with RPTs, there's more pressure on performance, there will be issues with performance of the investee companies that the private equity funds invest in, but also equally, we've seen some issues with the funds themselves and their governance. WeWork was one key example of that was written and discussed over, and there probably would be other examples. So I wonder if you could say a word as to how you see the industry, let's say, getting ready or geared from its own perspective, from its own governance. Are there some changes being undertaken?
I mean, I'd be surprised if there was anything systematic going on at all today. I think some funds are well positioned. They've always been conservative in their marks and have been prudent in their investments. I think there's a number of other funds that are now triaging for survival. They've gone out, they've fundraised on overinflated marks. Those marks are now compressing. They're reluctant to remark them in the optics and its impact on fundraising and others. And I think those funds ultimately have longer term survival issues that they've got to deal with. So I think this will bias to the more conservative, which will result in a little bit more conservative governance. You're seeing this in structures already: return to diligence, debt covenants, return to governance covenants, better term sheet, better structured term sheets in terms of investor protections, I think is where the market is swinging around hard right now. So I don't know if it's a systematic regulatory or everyone's getting together saying, hey, let's do this. It's just the market reevaluating and re-rating risk. And as a result, there's a series of mechanisms that start to come in to mitigate risk. And that just happens at this point in the economic cycle. As it relates to your comment about GPs, I think there's going to be a sub theme of that as well. I know one great business, they've made a business of being the successor GP. So they come in and take over when a GP fails or gets kicked out by their LPs with some fantastic returns and just horrific governance stories, that they've had to endure and experience as they've transitioned out. So I do think we're going to see kind of successor GPs as another sub theme of the market going forward.
Wow, that is really an interesting insight into kind of where the sector is moving. So I think today, in about half an hour, we've canvassed Canadian governance, American governance, GP, LP issues, protections, and some sectoral issues that we've addressed in this episode. Probably this is as much as we can fit in this conversation in about half an hour. It would be a pleasure to, of course, continue with you on future occasion. But for the purposes of today's episode, Mark, I would like to very much thank you for sharing your thoughts on this program.
Thank you, Lisa. It was a pleasure to be here.
Thank you. And for our viewers, I would like to also thank you for joining us and for listening in. We'll be continuing in the future episodes of Governance Dialogues, addressing, as always, interesting and exciting topics in the world of governance. So please stay tuned. And if these topics do interest you, I encourage you to subscribe to our program. Thank you for listening.